Hi everyone, welcome back to our Turning Point series. My name is Valentina Sanchez Cuenca, and I'll be your host today. Today we have our CEO Larry McDonald and also a longtime friend and contributor Craig Shapiro. Today the guys will be discussing consumer staples, oil consumption, data centers, AI, among other topics. And also a friendly reminder, we just came out with a new book called How to Listen When Markets Speak. Remember to get yours in the link in the description below. So guys, take it away.
Hi, it's Larry McDonald with the Bear Traps Report. Thanks very much for joining us. Special guest today, Craig Shapiro. Thanks for being in the house. We work over the years with Craig with our hedge fund clients in over 20 countries. Behind us, we run a institutional chat with professional investors. And, the Bear Traps Report in our new book, When Markets Speak, right over here, is really about democratizing information. And so what we're trying to do is we host intelligence calls with the buy side, with professional investors around the world. And we want to give investors globally a lens on a buy side conversation. Like, what are the professional investors really thinking about? Craig, on a daily and weekly basis, is talking to our clients. And, some of the big conversation pieces out there are just fascinating around the election, around liquidity. There's all these conspiracy theories around, Team Biden. They look back, think about the 2008 election, right? It was an election that had a financial crisis, a banking crisis in that year, and it had a big impact on the election. And but obviously, President Obama was an incredible candidate. He won. John McCain was a weaker candidate. But the last thing Team Biden wants is a financial crisis or a recession heading into the election. So as we had, the four different banks blow up, they've really thrown an amazing fire hose at this situation on the heels of an incredible amount of fiscal and monetary stimulus coming out of COVID. So what we talk about in our first book, which is a New York Times bestseller, it's now in 12 languages. It's a colossal failure of common sense. And we talk about that book, the fiscal and monetary response was about $4 trillion. And now, on the heels of COVID and this banking crisis in 2023 and a little bit in 2024 with New York Community Bank, we're talking about a 16 trillion fiscal and monetary crisis. And Craig can get into all the plumbing around liquidity, around the markets, and it's really a high point of interest we can see right now from a lot of the institutional clients. We wanted to kind of bring you behind the scenes. I think, Jose, why don't we kick it off with the slides and then I'll bring Craig in? Okay, so one of the things, Craig, I think is going on behind the scenes is so much liquidity has been thrown at the market that they kind of overcooked the goose here. And then we obviously have tensions in the Middle East this year. And so the kind of like I don't want to call them inflation gaslighters, but there's a group of people that, even though you're doing 16 trillion of fiscal and monetary, there's a group of people that have been selling us since 2021 that inflation is transitory. Inflation is going back to the previous regime. And it's kind of hard to believe with the 16 trillion fiscal and monetary response relative to to the previous crisis that we're going to go back to those old days of 1-2% inflation. But as you can see here, gasoline, because of all that fiscal and all that monetary, and then we're now in a multipolar world, as we talk about in our book, where you have more global conflicts. That's a situation that's really driven gasoline, and that's one of the things that's given us a bounce, higher. Next one, Jose. A bounce higher inflation. Okay, so one of the things we're looking at in the book is that, obviously in the last decade, there's a lot of energy demand coming from emerging markets. We've taken 5 million jobs out of the United States. We've exported them around the world. And PMIs in India, economic strength in India and around the emerging market space has been very profound, and it's having an impact on oil demand. As you can see there, Wall Street's underestimating the demand for oil from emerging markets. It's one of the big compelling parts of our book. when you take 5 million jobs out of the United States, you decimate the Rust Belt, you're raising the standard of living globally fairly dramatically. And so that's increasing energy demand. Once again, that's putting some inflation pressures back here into the United States. Next one, Jose. And this is where we get into the multipolar world. We've got drone strikes. This is a very unusual situation. Historically, we've never really had drone strikes impact oil markets the way they have this year. And so this is a situation that is problematic for both the Middle East and the Ukraine attacks on Russian oil refineries. And that's, once again, given us a lot of surprise to the upside. Next one, Jose. Gasoline demand, the bottom 60% of consumers, because of the pains of inflation, the pains of higher rates, mortgage rates, auto loans, all kinds of refinancing, has really hurt the bottom 60% of consumers. The top 20% are doing great. If you have money in a money market fund, you're really crushing it. You get about a 300% pay raise thanks to Jerome Powell. But as you can see here, gasoline demand is trending lower, bouncing but trending lower. Next one, Jose. And so this is one of the things that we've been talking about in our institutional chat. So when the staples start outperforming discretionary stocks, something's up in the economy. And so if you think of the XLY, close to 40% of the XLY is Amazon. Amazon equity is up 15% year to date. And so we have a dynamic here where the consumer on the discretionary side, now remember, those are discretionary spending. That's spending that you want to, you want to say buy a Tesla, buy on Amazon. It's not your staples. Your staples are recession-proof stocks. So this is a very important point around the staples outperforming discretionary stocks this year and quite violently of late. And so when you talk to institutional investors around the world, this is something that people are watching. Why are recession-proof stocks, why is capital flowing into them at a pretty violent pace? And why are the discretionary stocks performing so poorly with Amazon that's such a large component of the XLY? Next one, Jose. And so one of the things we're looking at here is growth to value. We've had a big move last week, which doesn't really show up in the chart, but a big move on Friday from growth back to value. As you can see there, it's a triple top. One of the things that we talk about in the book is if you go into a sustained inflation regime, you're probably going to get better outperformance of value versus growth. Whereas if you're in a disinflation regime, you're most likely to get substantial outperformance on the growth side, as we saw the last decade and a half. But if you move into a more sustained inflation regime, then the probability of outperformance on the value side versus growth rises dramatically. We saw that in 2022. As you can see, that line moving down in 2022 when we had that big spike in inflation, capital really moved violently from out of growth into value. And we think the setup is pretty similar now. Next one, Jose. Okay, so let's get into Craig. So Craig, here we are. Walk us through. So we have a fiscal and monetary response. It's about 16 trillion. Some clients say they want to run out the clock in Washington, where they want to spend so much on the fiscal side to avoid a possible recession, avoid that banking crisis, and really kind of keep things going. What's the 5-year auctions, the highest ever? I mean, walk us through what's happening in terms of auction sizes.
Yeah, look, I think there's a view that in markets that financial markets won't correct in election years, and that the government, the administration, in concert with the Fed, will keep the party going in order to help elect the incumbent or reelect the incumbent party. And so I think folks have a lens about what the Fed will do in light of an economic slowdown, or what the Treasury might do in order to help juice markets, to help Biden in his reelection campaign. I think, as you were mentioning before the call, just back in 2000, we had a very tough market. and there was a change in power, right? I mean, Democrats lost and Republicans won, and so maybe the administration didn't do a good enough job, or the Fed didn't do a good enough job, and there was a transition. And then in 2008, similarly, right, we had a financial crisis, and there was also a change in power. Republicans lost, Democrats came into power, and so I think markets look and say, well, Democrats and Biden right now really should be doing anything that they can in order to help get elected and keep Trump from being reelected. So the Fed's going to cut rates, and Treasury is going to act in a way to provide stimulus into markets. And so dating back to the fourth quarter of last year, the Fed had been targeting or had been signaling that they were going to do another rate hike. A substantial majority of Fed members said at the September meeting another rate hike was coming. And kind of on back of that, and on back of a 5% GDP quarter in the third quarter, the bond market sold off, the dollar rallied, oil was rising, term premiums were rising, and we were having.
And walk us through what what's the definition of term premium.
Yeah, so term premiums basically are the additional compensation that you, as an investor, are desiring to loan the government or any borrower for a longer period of time versus a short period of time. So if you're going to have you want to be compensated for lending money 10 years versus 1 year. And so that typically is a positive 50 to 100 basis points of incremental return. But it's actually been since COVID, it's actually been negative. And so the Treasury Department has actually been, benefited from this negative term premium. And so, but what was happening was we were seeing a rise in term premium. Folks were getting scared about the size of the deficits and the borrowing, and the bond market was selling off. And then this view came that, if we have too much of a correction and the economy slows, Democrats are not going to get reelected. And so we kind of engineered a kind of double pivot where the Fed never delivered the last rate hike, and the Treasury engaged in activities that assisted providing liquidity back into the markets by reducing the desired amount of duration issuance that they were.
So let's get into that. So in a normal world, a Treasury Department would issue 6 month, 3 month bills, 1 year, 5 year, 10 years, and 30 years. But when they do that, a 30-year bond moves, so much more violently. A longer-term bond, if interest rates go up, bond prices go down. So those longer-term bonds move so much more violently than your 3 month bond. So explain what she's done. She's in an election year. She's quite brilliantly front-end loaded the issuance. In other words, if she's issuing 3 month bills or 6 month bills, no matter what happens with interest rates, that big pile of money really isn't moving around. So it's creating less volatility in the bond market.
Right. So basically, when there was pressure on her in the end of October, she made this decision to slow down the growth of long-term bond issuance and kind of ramp up the growth of T-bill issuance. Even though yields on T-bills are higher, even though the yield curve is inverted, she made a decision to do that because there was and is excess liquidity in what's called the reverse repo facility, which is excess money that's sloshing around that was raised, over post-COVID, that kind of sits at the Fed earning 5.3%. And so Treasury kind of created an alternative where they could draw the money out of that account and kind of have a less adversarial impact on financial markets by doing all of the borrowing that the Treasury is doing. So she made the conscious decision to do that, issue more bills, issue less bonds. And what happened in November and December into January, while the Fed also never delivered their final rate hike, is that financial assets rallied immensely, stock market to the moon, bond markets rallied immensely, and financial conditions loosened significantly, really to the point where
that kind of gave inflation a boost, right?
So financial conditions loosened so mightily over that 3 month period of time that it started to have a real impact on the economy. It had a real impact on animal spirits. It had a real impact on inflation expectations, and then ultimately had a real impact on inflation. And as you pointed out earlier with respect to the gasoline chart, I mean, that weak dollar period, that bullish commodity period, allowed gasoline prices to really start to take off, copper prices, various other commodity prices, food prices, in addition to continuation of strong service inflation. So basically, the Fed and Treasury's pivot, providing this extra stimulus to run the economy hot through the entirety of 2024, really has created an environment where inflation now once again has become a potential election issue. And so we're at a point where the Fed, which had been talking about delivering 3 rate cuts this year, market, as we came into the year, was pricing 6 or 7 rate cuts. The market has removed most of those. But
in December, January, the market was expecting 6 or 7 total rate cuts either this year, or is it this year, next year?
Just this year. The market was expecting 6 to 7 cuts as we transition into the year. Again, a significant loosening of financial conditions. The Fed had been saying 3. And now, as inflation data has proven to be stickier and hotter than expected, the labor market has held in better than expected, and growth has been better than expected, the Fed continues to walk back that outlook about rate cuts. And so we're removing that Fed put, right? This idea that the Fed is just going to cut rates in an election year to help the administration. The market is kind of looking through that and saying, well, we're not really so sure. I'm not really sure that the Fed is actually going to be able to do that because inflation is too high, growth is too high, and the labor market remains pretty good.
So let's get into something important. Like, so when Powell says higher for longer, and you and I can talk, and you talk to our institutional clients around the world. You've been an incredibly valuable colleague and an associate of ours. But when the Fed says higher for longer, isn't that fairly disingenuous? Because if you look at this slide, interest on the debt is going to be, if they really stayed higher for longer, right? Interest on the debt is going to be 1.4 trillion a year from now. And so, like, think about how unrealistic that is relative to the defense budget, Medicare, Medicaid. And so talk about for a second the gamble that Yellen's making, because this is a political gamble, and you can see why she would do it. But if she's issuing so many T-bills, which are 3-month, 6-month, short-term debt securities, and the Fed goes higher for longer, or let's just say the Fed doesn't control inflation, and then inflation kind of stays high, and then she has to refinance all this debt at like an enormously high, much higher level. Then interest on the debt would go even more. It could potentially go to $2 trillion. So walk us through that kind of higher for longer for Powell, the kind of the BS in that, because at the end of the day, it looks to me like he's going to have to start doing some type of quantitative tightening, walk back, or may even do QE fairly soon.
Yeah, look, there's a lot of dynamics in play here. I mean, in theory, the Fed and Treasury are separate institutions. The Fed is supposed to maintain, its institutional independence. Whenever asked about fiscal deficits and the sustainability, the Fed says no comment. We just kind of deal with the economy that we have and the level of spending and deficits that Congress does. But we know we're on an unsustainable path. And so the question is, how long, can the Fed keep interest rates as elevated as they are now before it becomes a much bigger issue for the government's balance sheet? And are we in a period of fiscal dominance, as some people have suggested, or at least fiscal primacy, which is one where the Fed has to deal with the interest expense first and make sure that the interest expense is lower? I mean, truthfully, this isn't really the Fed's job, right? The Fed's job is not to enable, and this is maybe a little bit political, but the Fed's job is not to enable Congress and the administration to run deficits, for as far as the eye can see, as large as they've been, 6% of GDP in full employment with inflation running above target, right? It's not the Fed's job to discipline, to allow DC to do this. The Fed really should be disciplining DC by allowing the bond market to react. And typically, what would happen to a government who was, running these kind of deficits is interest rates would rise and rise and rise until the government kind of came in and said, okay, we need to raise taxes, we need to cut spending, we need to do something here to get our fiscal house in order. We don't do that here in America, and the Fed is part of the reason, because the Fed continuously comes in and interjects with incremental liquidity whenever the Treasury market dysfunctions. And so the Fed is in part to blame, for this. But, look, you're right. The more that Yellen issues short-term debt, the larger this becomes, and the sooner this becomes an issue rather than later. And so she should be issuing longer-term paper and terming out the debt, particularly given the level of term premiums being so low, which we mentioned earlier. But she hasn't been doing that. And truthfully, when this was happening back in September and October of last year, it seemed as though the market and the Treasury was worried. They were scared about the level of interest rates and terming out 30-year paper at 5% plus. And so they kind of pushed back and said, you know what, we don't want to issue as much out there. And they allowed the bond market to rally a bit and kind of lower costs. But here we are again, where interest rates are moving higher again. And it shows you that not that the Fed doesn't have control, but when you are so myopically focused on this concept of real rate normalization, which is basically saying that as inflation falls, if we keep rates constant, we're actually tightening policy because real rates are rising. That's been the Fed's focus. They are not looking holistically at financial conditions, which have loosened so mightily. And so they've allowed inflation to resurface by keeping policy too loose. And now we're kind of paying the price for that because inflation is back. The Fed is not going to be delivering those cuts. And so it's not clear to me that the market or that the market is going to kind of run through November without a hiccup at this point.
So if this chart, Craig, was a family or a small company or a business, it's just the most disgusting thing. This is the United States of America. And because we've front-end loaded so much borrowing into 3-month bills, 6-month bills, 1-year bills, I mean, this is appalling. $8.5 trillion. It's a very large, we have $34 trillion total debt, right? And so $8.5 trillion due in the inside of 1 year, which is obscene historically. And then it's 15.5 trillion in the next 3 years. And this is what I mean. If you go higher for longer to kill inflation, then your weighted average coupon is going to go from 2.3 to 5.3. Think about what that means. That means your interest on the debt's going to go from, potentially to 2 trillion a year.
Yeah.
Right. And so this is a very dangerous game they're playing. And I know they despise Trump. A lot of people despise Trump. Some people like him. Some people hate him. We impeached him twice. We got four lawsuits. But to front end load that much issuance to create that much liquidity, because if you were issuing a lot of longer term bonds, right, and farming out the debt, then the bond market would be extremely, I would say, much more volatile, right? Mm-hmm. But because you issued a 3-month bill, if interest rates go up, it doesn't move in price. A 6-month bill, if interest rates go up, it doesn't move in price. But a 10-year bond or a 30-year bond, if interest rates go up, that bond can drop. Apple issued a bond in 2021 that's now trading at in the 50s. It's maybe 40 to 65 cents on the dollar. So it's down 40 points, 35, 40 points. So that tells you how dangerous this game is. If you had issued longer dated paper, then there would be probably far less liquidity in the market, which would have created more market stress in an election year. And you could see why they want to do this. But now we have this problem looking out over the next couple of years, where if they go higher for longer to try to kill inflation, all that debt's going to be refinanced at a much higher price. Jose, next one.
I think a good analogy is like when you continuously cut down the trees in order to never have a forest fire, you wind up eventually getting a much bigger forest fire in the end that's much more destructive. And so what winds up happening is the Fed and Treasury, whenever they see a bout of volatility, they come in and do something to dampen that volatility. They provide more liquidity in whatever way possible, cutting rates, QE, less duration issuance, and so they're kind of pushing out the timeline to when they have to eventually deal with this $35 trillion of debt and this $1.5 to $2 trillion of deficits. The issue now, though, is, as you mentioned in your book, and it is now that we're in this multipolar world where other countries can purchase commodities away from US dollars and transact away from US dollars, you're losing the foreign demand bid for US treasuries. And so that means that the foreign central banks, whether it's China or others in Asia, have less need and less desire to hold U.S. treasuries on a going forward basis. And Treasury has noticed this in the November TBAC report. They talked about the structural decline in foreign demand, and that probably never coming back. That's price insensitive buyers, foreign central banks, who are going to be increasingly not buying treasuries in the future. And so as that happens, cost of borrowing for the U.S. government is going to continue to go up and up and up. So we are going to eventually have to deal with all this. Now, I think ultimately the Fed and Treasury do not want to create the crisis. And so that's why they come in and sell volatility. But what that means is that we are creating an environment where inflation never goes back to 2%, right? Because the incessant liquidity and the weakening of the dollar and the potential for yield curve control in the future or QE in the future to deal with all this paper that's being borrowed by the government and the increasing deficits means the dollar is going to be the outlet, right? And the dollar is going to continue to devalue against hard assets like gold, like oil, like property. And so we're moving down in that direction.
So if the Fed's forced to help out more because of issuance. So this is an example of, this is the 5-year note. So we talked about there's a lot more issuance on the front end. So it's 1 year, 2 year, 6-month bills. 5 years still relatively short term, but this is incredible, Craig. So 2017-18, we were issuing, and each one of those dots is, I think, is an auction, right? So in 2017-18, we're issuing $30 to $35 trillion per auction, right?
Billion.
And then, as you can see, during COVID, we got up near 60 billion. So so you went from 30 to 35 billion to 60. And you can understand why it's COVID, right?
Yep.
Now here we are in an economy that's near full employment, where we're lectured every day that it's a strong economy, and we're issuing close to 70 billion up. The next couple of 5-year auctions are going to be 70 billion in size. And so that gets back to, if there aren't enough foreign buyers, and we have a lot fewer friends in the world today for a whole bunch of reasons. And that's not, you can't blame that on Trump. You can't blame that on Biden. There's a whole bunch of reasons why we have less friends in the world. It goes from Republicans and Democrats across different administrations. But if you use that sanctions head over and over again on emerging market countries over 10, 15 years, and then you start confiscating capital, eventually you're going to have less buyers of your bonds. I'm sorry, that's just the way it works. And so as you can see here, this speaks to a potential hint of the future where Powell might have to step in, and once he's forced to step in and do a little bit more QE to support the bond market, that's where you get a weaker dollar, and that's where you get this big move from what we call financial assets, that's bonds and growth stocks, over toward more hard assets, and that's more commodities, oil and gas, and things like that. Jose, next slide. And so, Craig, walk us through this. So what clients are saying, when I talk to hedge fund clients around the world, they're saying, you see, so when we had the financial crisis last year, and it wasn't a big one. But one of the reasons why it wasn't a big one is people don't understand the size of the fire hose they pulled out. That green line, that's a $3.5 trillion fire hose, right? And so they went from a what's called quantitative tightening back to quantitative easing. Those green bars are quantitative easing where they're supporting the bond market, and then they went back to quantitative tightening. But you see those small green bars on the lower right hand side. People say that the Fed is doing this stealth taper of the QT. Can you walk us through that?
Yeah, look, I mean, I think basically what the Fed is doing is there's a 60 billion a month in QT runoff, right? Which is as bonds and bills mature, the Fed doesn't reinvest them into the new issuance, and so that reduces the size of the balance sheet. 60 billion a month in treasuries and 35 billion a month in mortgage-backed securities. That was the plan. First off, on mortgage-backed securities, because of the rise in rates, mortgage-backed prepayments have been much lower, and so the Fed has just not been able to run off as many MBS securities as they thought. And so even though the Fed has talked about this 95 billion a month of quantitative tightening, they've rarely got there, and it's gotten much lower as rates have moved higher because the mortgage market is not providing a lot in the way of prepayments, which would be these runoffs. And so as far as this kind of stealth taper idea, look, I think I'm not really so convinced that they are targeting certain maturities, but there certainly are times during the month when we know things mature and things, whether it's the 15th of the month or 30th of the month, it's just this is the regular calendar. And we also know when Treasury is going to be issuing its paper. It issued, this week it was 2s, 5s, and 7s, and last week was 20s, and 2 weeks before was 10s and 30s. And so there's a regular cadence to all this. The Fed is not really, though, they're not really doing QT. They're not doing what they do in the UK, which is actually selling securities, right?
Yeah,
we're just
exactly.
rolling off maturities. And so in quantitative easing, it's like the Fed is buying bonds. But in quantitative tightening, the Fed is not selling bonds. They're just letting bonds roll off. So it's not even real, QT. There's a certain asymmetry here where the impact of QE is much, much greater than the impact of QT, than the US version of QT, because we don't sell. And so again, that's another reason why inflation is having trouble getting back to target. It's just that there's too much liquidity still in the system, and the Fed has been reluctant to use the balance sheet as a more aggressive tool to bring down inflation. That's what they should have done to begin with, right? Because there's an argument to be made for the fact that rate hikes this cycle have actually been stimulative. They've actually been providing accommodation because, for one, households and corporations were able to borrow long-term during COVID, right? Mortgages set at very low levels, corporate borrowing set in 2020 and early 2021 before the rate hikes came in. We're done in the, when the 10-year was, sub 3%. Many mortgages are done at 3% or lower. And so you kind of have a situation where as rates have risen and the government has been paying out 5-6% a year in deficits as a percentage of GDP, that's become like interest rate stimulus, right? It's not like COVID stimulus. It's interest rate stimulus, and that wealthy individuals and wealthy corporations are basically taking in these interest expense payments and helping to amplify their own consumption. And so
if you had 10 million
have not worked to bring down to slow the economy like they have in the past.
Yeah, so $10 million in a money market fund 2.5 years ago was about 80,000 a year of interest, 75, 80 on 10 million. Now that's a wealthy guy, a wealthy couple and a husband and wife in Palm Beach with 10 million in a money market fund. But as an example, and now we've gone from 75 to 80,000 a year to 450 to 500,000 a year. So that's, Einhorn talks about, David Einhorn, David Tepper in our book. We sat down with Charlie Munger. So we sat down with a lot of really talented billionaire investors. And one thing Einhorn said over the years, he called it the jelly donut, and he talked about QE is because the boomers have about 78 trillion of wealth, the baby boomers, and that's the oldest baby boomers right now, about 78 years old. So they have close to 80 trillion of wealth, and they're approaching 80. But they if you doubled or tripled their income in a money market fund, that's going to create some economic activity. Now, Craig, the RRP, everybody talks about it, right? And so walk us through. So as if Yellen's issuing T-bills aggressively, like 70 billion in, say, a 5-year, a lot of, or that's bonds, but T-bills or the front end of the curve. She's issuing a lot of paper aggressively in short-term paper. Forget about 5 years, but in those yields, because she's selling so much of them, Treasury is, they make the RRP less attractive, and then all of a sudden the RRP. Walk us through the impact on liquidity and how some people in the chat, some of our institutional clients think if this RRP gets down near somewhere near zero, then we're going to have a liquidity problem.
Yeah. So the RRP yields 5.3% currently, and so in order to move money out of the RRP, Treasury, when it issues bills, has to offer an attractive yield to kind of incent money market funds to take the money out of the RRP and actually give it to the Treasury in T-bills. Now, there are some reasons why these money market funds have to be in T-bills, and there are some benefits from a collateral point of view, why you'd prefer being in a T-bill versus the overnight repo facility. But broadly speaking, we're kind of at that point now where it's comparable to invest in the RRP versus to invest in, let's say today, there was a 6-week T-bill that got done at 5.28%. And so there are some that believe that the pace that we've reduced this facility is going to go to zero imminently, and that means that the Fed is going to engage in tapering of QT because we're going to have a banking issue sooner rather than later because reserves are not ample. And I think that there's a little bit of a flaw in that logic, because what Treasury has said in the second quarter, because the second quarter is when we get tax receipts, which have just come in, Treasury is going to have negative bills issuance in the second quarter. And so
much tax revenue comes in a very short period of time that all of a sudden they go from issuing tons of bills to slow it to
exactly. So what we've already seen, my sense is we've already seen the low in the RRP for the second quarter. That happened on tax day. So we were probably in I forget what the number was, maybe 325 or 350 billion. My sense is that we'll continue to grind that number between 350 and 450 through the end of this quarter, and probably kind of stay there for the third quarter as well. That number really is only going to be reduced over time as the Fed continues to reduce its balance sheet. Now, the other offset here that we have to think about is the Treasury general account, right? So that money that got paid out of the RRP and out of bank reserves to pay their taxes is money that went into the Treasury general account. That's basically the Treasury's checking account. That number, I think, currently is about 950 billion. Probably will peak out this week as you get the tail end of some of the April tax payments coming in this week. So call it 950 billion in that facility. Yellen has said that facility will end the quarter at 750 billion. So she's going to be able to put back 200 billion or so of incremental liquidity from the TGA back into bank reserves over the course of the next 8 weeks. But broadly speaking, I think there's a little bit of paranoia about the fact that as these facilities get run down so rapidly, that we're going to have an imminent banking crisis. And I think what the Fed is trying to do, obviously, is prevent an imminent banking crisis where bank reserves are too low. But it's important to remember that bank reserves, based on that chart you showed earlier, that SVB capital infusion, bank reserves now are still reasonably high, certainly well north of $3 trillion. We're not in really any jeopardy of an imminent banking crisis. There are some banks that are in a worse reserve position than others. And there's an uneven distribution of reserves that the Fed is going to want to deal with, and that's why they're even contemplating this tapering of QT down from 60 billion to 50 or 40 or 30 or whatever amount it's going to be. But I think what the Fed wants to do is to gradually continue to reduce the size of its balance sheet over time, and kind of clean up some of this ample liquidity that remains in the market.
And so when you think about the U.S. economy versus the rest of the world, one of the things that impacts the dollar is what the Fed's doing. So if the Fed is, if say the European Central Bank is offering far more faster and immediate rate cuts, that's going to weaken the euro and strengthen the dollar. And so we've had this move in the last couple of, maybe like 5-6 weeks around, some inflation surprises to the upside. So all of a sudden people say, okay, the U.S. economy is strong. The Fed can't cut as much. And so therefore, as you can see, the probability of rate cuts in June has gone down to 28% on the Fed side, but up to 92% on the ECB side. So that it has been over the last say 5-6 weeks, strengthen the dollar, weaken the euro, and that has a lot of impacts globally, where we get back to the dollar wrecking ball thesis, which can play back to the U.S. as well. Can you get into that?
Yeah, the pace of growth and inflation in Europe has been less robust than we've seen in the U.S. Right? Europe has not had anywhere near the level of fiscal accommodation, fiscal deficits that we've run here in the U.S., and hasn't had nearly the level of wage inflation that we've seen here in the U.S. As well. And so Europe, it has been faced with a more dour outlook. And so the idea that Europe can cut rates sooner than the U.S., I think makes a lot of sense. And so then you're going to be in a situation where growth differentials kind of favor the U.S. over Europe, yield differentials favor the U.S. over Europe, and more likely what you'll get is a continuation of a dollar rallying against the euro. I think this exists, and you're showing the chart here of the dollar versus other emerging market currencies, and a similar dynamic is in play as the U.S. growth dynamic and yield dynamic remains as strong as it is. It pulls capital from some of these other emerging market economies that either have.
So when the Fed's like keeping rates up high,
the Fed's keeping rates up, and so yields
that
are
sucks capital
to
in
the US.
To dollars.
Right, it pulls money out of emerging markets, and so emerging markets will need higher yields to attract that capital back. And now the emerging markets are dealing with their own growth issues or growth strength, and so not every central bank in Europe is going to be either hiking or loosening, but broadly speaking, that positive environment for the dollar pressures emerging market assets, as you're you're shown here. So I think that's
if you're a truck driver in Brazil, Brazil has most of emerging market countries, many of them have no rail system. So trucking is your rail system. And if you're a truck driver in Brazil, oil prices, gas prices are up 40% since December. So your oil's up, but that's priced in dollars. So your dollar rips, and it's double whammy, huge negative impact. And remember, there's 75 trillion of GDP outside the United States, right? And so there's a lot more GDP outside the United States than inside. In the old days, the planet was more balanced. Now, when the dollar strengthens, it has a very serious impact on the global economy, and that feeds back to a negative feedback loop. We saw that in 2016.
You don't have it up there, but the country that's really in a very, very tough spot here is Japan, because Japan has a very significant import bill for energy, prices all that in dollars, and really can't raise interest rates very rapidly given the level of debt in Japan. And so you're kind of in a situation where dollar yen will continue to rally, and Japan needs to find a way to generate dollars in order to pay up for that more expensive energy. And so Japan has actually been I think, at the foreground here of been driving some of that regional currency weakness, whether it's in the RMB or the rupiah or the
So
yuan.
let's walk through that. So
Yeah,
dollar strength in China, the yuan's pegged to the dollar. I know there's a band, but if the dollar's, if the rate of change in the dollar in a strengthening mode is pretty fast, and the ability of China to play with that band, so you get a stronger yuan, then all of a sudden, Japanese exports globally. Um, how does that affect like the battle between Japan? So if you get a much weaker yen,
right.
right, or a stronger yuan in China, so it's basically like Japan is stealing massive amount of trade market share from China because of their currencies not pegged to the dollar. Is that essentially right?
Yeah, look, I think Japan is because of this, because the dollar yen has moved, the yen is rapidly depreciated. It's making Japanese exports more competitive. And so if you're in Korea or if you're in China, you're looking at that and saying, well, we need a weaker currency now to keep competing with Japan. And so you're seeing the Korean won has been depreciating, and even the RMB has been depreciating as well, although not as rapidly as the yen. And part of the reason I think why China's currency, although it's been weak, hasn't been as weak as the yen is because China actually can price commodities in RMB, right? And so they don't have this situation where they are looking or needing to find dollars in order to pay for energy. The other thing that China has is the ability to buy discounted energy from Russia and from Iran at anywhere between 20 and 40% off versus what Japan is buying from Russia. Japan really doesn't buy from Russia. They can't buy from Iran. So Japan needs that weaker currency in order to compete with China.
Yeah.
So look, I think you are in that situation where the dollar, strength and the high yields in America and the fiscal deficits in America that are keeping growth robust are actually putting some strain on the rest of the world who either can't afford to pay up for these more expensive dollars or are competing with other countries who are in export markets with weakening currencies. So there's a bit of a competitive devaluation situation going on.
And you can see there, like, as the Fed pushes, it keeps rates up higher for longer. That sucks dollars in that dollar strength, that's the dollars into the United States. It's made emerging market equities, that cheap. I mean, that you're talking about going back to 1949 there, one of the cheapest levels. And I would say, though, if you believe that higher for longer is BS, and the fact that we just went through a whole bunch of reasons why they might not be able to go higher for longer, at some point, it's like a rubber band, it's like a beach ball underwater, right? Emerging market equities, they're really cheap. And if the Fed's forced to reverse for policy toward a more accommodative stance relative to hawkish, then all of a sudden that beach ball underwater pops up and emerging market equities dramatically outperform. Next one, Jose. As you can see here, one of the great leading indicators is the emerging market local currency bond fund. We think it's one of the more attractive plays now. You get almost 6.5% yield there. As you can see, that dollar strength, you see the white line going up. That dollar strength has really pushed down emerging market local currency bonds. And so we've been talking to clients around the world. I mean, this is an area where if you believe higher for longer is BS, or if you believe that the Fed's ability to go higher for longer, the dollar strength is going to be that wrecking ball that breaks something. The EMLC, as you can see, when you get a weaker dollar, the EMLC from 2022 to 23 went from 90 to over 100. So not only are you getting 6-7% yield, and then you're getting a 10% appreciation. So this is something to watch because you want to keep an eye on leading indicators like emerging market local currency bonds. Jose, next one. Now, this is what you were getting at earlier, the term premium. So the term premium is having a massive impact on. See, for the last 100 years, the United States really never had a term. Primarily didn't have a term premium problem. But countries like Brazil, Argentina, longer dated bond sales, if you want to borrow money for long periods of time and you're an emerging market country, that's where the term premium really exists, where if some investors in the world just don't trust emerging market countries for, say, 20, 30 years, they'd much rather give the U.S. some money. But the moment the U.S. becomes slightly more like an emerging market country in terms of fiscal irresponsibility, in terms of things that really freak out investors, that's what creates this term premium expansion. And this is one of the most important charts you'll see because that is really a scary thing if you're a bond issuer, because all of a sudden, as the United States, if global investors just aren't trusting us much on the long end in terms of issuing longer dated paper, that actually causes a lot of changes in asset prices. And what we argue in the book is it moves money from what we call financial assets, which are bonds and growth stock, over hard assets, value and commodity plays. Jose, next one.
I think the key there is that we are currently in a new or a different regime from the dollar's point of view, right? The dollar as the global reserve currency had allowed the U.S. to kind of exist with these deficits and growing the debt, and in a situation that it didn't look or behave like an emerging market. But as we've seen over the course of the last couple of years, really driven by two main factors, that's begun to change. One is what I mentioned earlier, which is the pricing of commodities in currencies other than dollars, right? And you've talked about this in your book, but China's ability to price energy in RMB and buy it from Saudi or buy it from UAE and then settle excess trade reserves in gold has kind of moved the primacy of the U.S. Treasury as a neutral reserve asset, off the front page. And so that we talked about this.
And you can see it right there in the chart, the Bitcoin, gold.
And so that's made what the U.S. is doing look a bit more like an emerging market and starting to trade more like an emerging market. And the second thing just has to do with, and we're seeing it again, I think even today with Blinken's trip over to China, where he's threatening sanctions on Chinese banks for helping to finance Russia's war with the Ukraine. And we saw it obviously in a much larger way in February of 2022, when we decided with our allies in Europe to basically sanction and expropriate Russian reserves and kind of kick them out of SWIFT. That countries that increasingly find themselves as potential enemies of the West are going to be kicked out of the Western.
And the SWIFT system is like the monetary system of the planet Earth. So you get kicked out of that,
they're not going, if they feel like they're going to be threatened, they're not going to hold reserves in currencies that are part of that Western system. And so again, it's another reduction in demand for U.S. Treasuries from a long-term perspective. And so now what you're seeing is the U.S. is starting to trade and act a bit more like an emerging market, right? When you have these big deficits and you have a government that is increasingly financing itself with bills rather than bonds, these are the tell signs typically in emerging markets that trouble is on the way. So we're on the pathway towards that, and I think these higher yields that we continue to get and some weakness in these auctions is the early signs that this is going to be a problem that exists and stays with the U.S. government for years to come.
And you can see the rate of change, the violent upward move there, and so that those violent upward moves on the right, that's the S&P that's gold outperforming the S&P 500. And as you can see, if you look carefully, I guess since the third quarter of 2018, gold is outperforming the S&P 500 if you entered the market at that point. That's cherry picking, but it is weird because, to have, gold outperforming the S&P over 3 years, over 2 years, over say 6 years, it's very ominous. And this speaks to what you're talking about is planet Earth kind of moving money away from treasuries and into other kind of harder assets. Next one, Jose. And same thing with the Dow Jones Industrial Average. So this is the Dow Jones Industrial Average versus gold, and it's on a ratio. So as that as gold breaks that lower bound there, that's gold outperforming. So that's important so gold's outperforming the Dow, quite meaningfully there in recent years. Next one, Jose. Now, this Craig, to me, this is such a cool chart because on Friday, the Dow Jones Industrial Average outperformed the NASDAQ. So if you really go into a world with more sustained inflation, investors tend to own more industrials value stocks relative to growth. And the FANG's very, very crowded play because we were lectured over the last year that the Mag 7 are the place to be because we're going back to 1-2% inflation. And so, there was such a unanimous view on this 1-2% inflation regime that's going to come back that everybody got long that 2010 to 2020 portfolio, and it's a very crowded trade. And so what's happened, what I think is fascinating, you see those blue dots. When you get one of them, like you see historically, it doesn't work every time, but historically you get one, more come. And so this is the Dow Jones Industrial Average, so those blue dots, outperforming the NASDAQ on, say, 2.3 to 2.5% in one day, to keep it simple. And so once again, when you start to see those blue dots, it's a signal of potential regime change. So in like 2021, 22, there was a real inflationary period in the United States. Growth underperformed value, and so the industrials outperformed. And I just think it's very, it's a very good leading indicator. It's not 100%, but when you see the Dow Jones Industrial Average outperforming the NASDAQ by 230 basis points with 2.3% in one day, that means something because you can see in the last year and a half, 2 years, those things have been pretty rare. Next one, Jose. And once again, so we're talking about long duration equities. The best example of a long duration equities is your cloud computing, your software companies. So you can see there the cash cows, which are more value equities, dramatically outperforming software in recent months. And once again, that's a sign that the market's worried about duration because long duration equities are companies that have like nice cash flows over time, but they don't pay any dividends. They don't retain cash. And so if you're delivering cash flows over time and not building cash the way a cash cow would be, and that's like cash cows are like oil stocks, real value stocks, refiners. This is a classic warning sign or a potential sign of a shift of money moving from, say, long duration growth over toward value because the market is concerned about higher rates and inflation in a sustained inflation regime. This is a great leading indicator of that. Next one, Jose. Same thing here. So here are your copper names, your hard assets, versus your long duration software companies. And remember, the CLOU was the sexiest ETF in 2021 in that kind of low inflation, disinflation regime. And so once again, and we talk about this in our book, When Markets Speak, but we go into what are long duration equities versus short versus value versus growth. And as you can see here, that, Craig, is a very rare thing when you have copper names outperforming software names by that much in that period of time. That's a sign that money is panicking into hard assets, and that's a sign that people are worried about, like you said, term premium. They're worried about higher rates and inflation. Next one. ExxonMobil versus ARC, same type of thing, same story. That's your classic value versus growth. That's been very, very violent move back into Exxon versus ARC. And I think that's about it. One more, Jose. And then right now, if anybody wants these slides, just reach out to Valentina at thebeartrapsreport.com, Valentina at thebeartrapsreport.com. We have to go because I told Craig just an hour, but we get into in the book a fascinating development around energy demand in emerging market countries, energy demand in large cap equities. And so your large cap equities, like, I'm sorry, your Mag 7s, for example, or your FANGs, you're talking about a spectacular surge in energy demand from these companies through artificial intelligence. and we just don't have the infrastructure to support that. There's a lot of trades that are coming at us right now, a lot of investment opportunities. These are the most incredible time of our lives. Like we're talking about, the most interesting period to invest, where we're talking about colossal migration of capital. It's all in our book, When Markets Speak. Pick it up. It's been number one across many different categories on Amazon and the business side. And our first book was a New York Times bestseller. We think we're going to we think we're very close to that in the second book. And we really appreciate you being here. Thank you, Craig. We'll do it again. And always remember, when markets speak. Appreciate it.
Thank you, Larry. Thank you, Craig. And thank all of you for joining us today. I know this conversation will be very insightful for all of our viewers. So, as you can see in Larry's background, we run a Bloomberg live chat with more than 660 investors all around the world. If you're interested in having a trial for that, do not hesitate to reach me out at valentina@thebreadshopsreport.com. That's valentina@thebreadshopsreport.com. Also, if you're not on Bloomberg, no worries, we have the service just for you. You can get our weekly macroeconomic recap and overview, or our daily client chat recap for 21 days. I'm happy to give you a trial for that. You can also reach me on my email that you can find down below. Also, don't forget to buy your copy of How to Listen When Markets Speak. Thank you so much, and we'll see you next time. Bye.